January 3rd, 2026. That's the date. But here's the deal. This isn't about Maduro. Not really. This is about control. Control of the world's largest proven oil reserves. And that lock just opened. So who captures value? Who faces systemic disadvantages? And more importantly, where does capital flow from here? Today, we're mapping the mechanics behind 303 billion barrels. If you're ready, let's examine capital's new trajectory. Let's be real. When you hear Venezuela, what comes to mind? Crisis, chaos, Maduro. But here's a number. 303 billion barrels. You heard that right. 303 billion. This reserve exceeds even Saudi Arabia's proven capacity. Venezuela alone could supply the entire America's oil demand from domestic sources. So why hasn't anyone accessed this reserve until now? Simple answer. The Maduro regime created structural barriers. Foreign capital was blocked, infrastructure deteriorated, and the country couldn't monetize its own resource base. Now the framework is shifting. American oil majors have positioned for this inflection point for years. ExxonMobil, ConocoPhillips, and particularly Chevron, they represent the first mover advantage in this reconfiguration. Chevron holds unique positioning here. Here's why. During peak sanctions, they never fully exited Venezuela. They maintained partnership agreements with PDVSA across 5 major projects, built networks in both Caracas and Houston. That's asymmetric exposure. Chevron doesn't just enter first, it scales faster than anyone else. Post-operation, oil equity volatility increased, but the systemic repricing hasn't occurred yet. Why? Markets are in discovery mode. When the new government stabilizes, sanctions lift fully, and production agreements finalize, that's when we'll see significant multiple expansion for positioned players. But wait, while oil majors dominate headlines, the real value capture happens elsewhere. Who are these players? Let's examine. So, while oil majors grab headlines, who's quietly capturing structural value? Halliburton, Schlumberger. Their value thesis is simple but unshakable. Regardless of who wins, regardless of which flag flies, those pipelines get laid, those wells get drilled, and those refineries get rebuilt. And there are very few entities globally that execute this at scale. For these companies, Venezuela represents a generational infrastructure cycle. The country's asset base is so degraded it requires billions in rehabilitation and modernization. Wells need intervention, refineries need retrofitting, pipeline networks need replacement. Every new production agreement flows through these infrastructure specialists first. Recent sector activity is notable. Markets understand exactly who executes the actual operations. Halliburton and Schlumberger may not always report the highest margins, but they never report losses. Why? They are the mechanism itself. But now let's examine the real story. A sleeping giant is waking, and this giant's potential could shock the system. Now let's flip the configuration. Venezuela's own entity, PDVSA. The company sitting on the world's largest proven reserves operates drastically below capacity. Why? Systemic constraints from the Maduro regime. The regime didn't just block foreign capital, it restricted external sales, essentially trapping the resource domestically. When you can't monetize a resource, capacity expansion makes no economic sense. But the wind is shifting. When new leadership enables external trade, forget new wells, just removing existing constraints could double PDVSA's production capacity. So why is PDVSA's underlying potential so significant? 2 fundamental factors. First, reserve scale is mathematically unmatched globally. Second, technology leaders like Chevron and ExxonMobil are now positioned at the entry point. These majors bring not just capital, but the advanced technology to rehabilitate degraded well infrastructure. That massive reserve base sitting dormant, generating zero cash flow, can transform into an active cash-generating asset. PDVSA's resurrection from operational dormancy could represent one of this decade's major value creation narratives. But here's the framework: every rise creates displacement somewhere else. As Venezuela ascends, who faces structural disadvantages? Every systemic shift has displacement costs. As Venezuela rises, certain legacy powers face pressure tests. First impact: Middle Eastern producers. Consider this: the US currently sources significant petroleum from Saudi Arabia. But when massive reserves activate in your own hemisphere, why maintain long-haul logistics with higher transport costs? The Trump administration's cheap energy policy configuration could rotate sourcing from east to south. And it's not just America. The European Union is examining Venezuelan supply arrangements. This means the global market no longer has a single dominant supplier. A second giant is rising alongside the Middle East. Second systemic loser, China and Russia. These countries invested heavily in Venezuela for years, providing credit, purchasing output, building relationships. In an American-dominated framework, China and Russia's Venezuelan influence contracts significantly. The underlying logic is straightforward. When production and optionality increase while demand holds constant, prices face downward pressure. For legacy producers, this means margin compression. But for new entrants, it creates massive scaling opportunity. And here's the positive externality for end consumers. Increased supply should produce notable fuel price deflation. Capital is changing hands. Power equilibriums are resetting, and we're witnessing the early mechanics of this new configuration. But hold on, we can't skip a critical detail. Venezuelan oil isn't straightforward. One detail we can't overlook. Venezuelan petroleum falls into the heavy crude category. What does this mean in practice? Standard refineries can't process it. It requires specialized refining infrastructure and more complex processing pathways. This is where it gets interesting. Companies like Chevron's Advantage compounds, they already possess the refining infrastructure to handle this crude grade. Even with production increases, refining costs remain elevated. And there's competition. Guyana's recent discoveries of lighter crude grades could compete directly with Venezuelan output. So here's the complete picture. Venezuela holds massive structural potential, but actualizing that potential involves significant technical and financial complexity. Let's pull this entire analysis together. What's the systemic picture? Let's synthesize. Here's the complete framework. From outside, this looks like political chess, border disputes, or regime change theatrics. But when you examine the underlying mechanics, you realize every move is built on financial calculations and massive systemic reconfigurations. One certainty in this new configuration: every political action creates economic ripple effects. And in this system, every ripple eventually touches capital flows. In today's Venezuelan transformation, the pattern holds. Capital flows toward those who can identify and analyze structural positioning, not just react to headlines. As wealth trajectories redraw, we're not just observers, we're analysts understanding and mapping these shifts. If you want to continue tracking capital's hidden pathways through this type of analysis, supporting the channel keeps you part of this analytical journey. Remember, even inside chaos, there's always a harbor for those who understand the navigation mechanics. For now, wishing you clarity and peace. Until next time.